And our next topic on our outline is forex trading strategies. We will be studying charts and pointing out some strategies in those charts. I'll show you an image and then explain the image so that you will understand. Do not trade every single doji you see. What is the difference between a good and a bad doji signal? Now we want to target dojis at points on the chart which have high technical value, locations where you know the market has a decision to make, looking for key locations like support and resistance, swing levels within a trend lines and trend channels, chart pattern formations, and Fibonacci ratios. It's all about using your technical analysis to find key areas where you know the price action has a break or bounce to make. Let's take a look at a signal that fits within the market context. This market is making higher highs and higher lows, which is a bullish market where we would be looking to buy only. A bullish rejection candle formed here. The trade idea is within the context and has a lot of technical value. The bullish rejection candlestick sign had good follow through, which is expected to continue going up because it was backed by a hammer on a support level. If you look beyond the candlestick, you can see the market is very bullish. That is evident by the higher highs and higher lows being printed, which is the footprint of a bullish trending market. If you want to go against that, you need to have really strong technical evidence that a reversal is likely to occur. I explained to you how flag formations are formed. This is the hourly chart of the GBP USD Forex pair. This image illustrates how you would perform your analysis to arrive at a potential trading opportunity. You see the green channel on the chart, the movement when the price action broke through the upper level of the flag, which can be called a descending channel. This creates a buy opportunity on the chart, and once the trade is executed, you should put your initial stop loss right below the lowest point of the flag, as shown on this image, stop loss 1. Then with each target, the stop loss order should be moved upwards, locking in profit as price advances. The two other trailing stop loss orders are shown with stop loss 2 and stop loss 3 using SL. Now let's demonstrate a trading situation and how you can adjust a stop loss order on a price chart. This chart is the hourly chart of USD JPY pair. The image gives an example of a long trade. The blue horizontal line is a resistance area created by the two tops. The moment when the price action breaks the resistance area upwards, creating a bullish potential on the chart. This is a nice opportunity to buy on the assumption that the price will increase. A nice place to put your stop loss will be the level of the bottom created before the breakout. Now, if the price decreases to that level, then the chance of an upward bullish trend is reduced. We marked the initial stop loss. Notice that the price starts an increase, and after finishing the impulse, the pair creates a correction. When the correction is finished, it starts a new bullish impulse. You can move your stop loss manually, in this case, to the level below the first correction, stop loss 2. Now your stop matches the resistance level you used to enter the trade, which means you have moved your stop to break even and are currently not risking any further on the trade. At the same time, you are still in the trade for a possible winning scenario. You may have noticed that the market doesn't move in a straight line from point A to B on the chart. Instead, price moves from high and low point, gradually stepping its way higher or lower down the chart. These swing highs and swing lows are key technical points on a price chart which can help a trader anticipate where the market is heading with high accuracy. Boxing of price action is the first sign of poor trading conditions and low liquidity. Generally, the market will pause in anticipation of the move from central banks. Now, there is a theme or situation surrounding market consolidation like debt crisis or if a central bank is going to print money or not. The market wants to know what action the government will take to respond to the crisis at hand. Government and banks are fast to acknowledge the problems but slow to respond. Now, the time difference between acknowledgement and action is when we see market activity die off and periods of low volatility born. This is an example of a failed bearish pin bar on a daily chart. In this example, once the market broke the key level, it spent 5 days traveling lower. This gave us the swing low as illustrated in the image. Now, it's logical to look for a pin bar reversal from the level. However, instead of taking another 5 days or more to go back to this level, the market retested it in less than 48 hours. And the price action was telling us that there was significant demand below this key level. This is a great example of a pin bar that forms after price broke through support and then retested it from the other side as a resistance. The Fibonacci tool can be used to trade inside bar, pin bar, and the engulfing bar setup. This trade is very profitable because there are a lot of factors of confluence that encourage us to place an order. The first is the trend. It is down. After it went down, we should expect a reversal. The second reason is the key Fibonacci ratios that represent a support level, and the third one is the inside bar false breakout. One signal is not enough to make a good trading decision. You have to look for multiple triggers that support your analysis. This way you will put the odds of success in your favor. Technical analysis can be very complicated if you don't focus on the most important basics such as support and resistance levels. These areas represent a psychological level where the game is played between buyers and sellers. Now, if sellers overcome buyers, they will push the price below the support level. So buyers will feel afraid to lose money because they see that the support level is broken. Buyers will feel afraid to lose money because they see that the support level is broken, so they will get out to cover their loss. Others will notice that sellers are in control of the market. They will decide to sell. Now, this illustration shows how sellers broke the support level. An inside bar is 2 candlestick pattern. It is sometimes called harami pattern. The first one is called the mother candle. It is big and large. The second one is smaller. It is located inside the mother candle. This illustration shows inside bar at top and bottom. As you can see, the second small bar is entirely contained by the first one, which is the opposite of the engulfing bar pattern. The inside bar is seen as a reversal pattern because it indicates that the market is likely to change, especially when it is located at a support or a resistance level. It is also considered as a continuation signal in strong trending markets. The inside bar can be traded successfully in trending markets, particularly if the market is moving strongly. Now, this strategy is straightforward. You have to identify a strong trend and wait for the formation of an inside bar pattern in line with the direction of the trend. We don't have necessary confluence to consider this a worthy pin bar to trade, and the pin bar has everything going against it except that it is a well-formed pin bar. The two most important reasons why I wouldn't trade the reversal pin bar is: the first, it's going against the major trend. The second, there is no resistance level to give me reason to believe that it is indeed a reversal point in the market. That about wraps up confluence. Think of these confluence factors as your pre-trade checklist. Confluence simply means the coming together of two or more things. For forex traders, confluence means the coming together or combination of two or more price action patterns, levels, or candlestick patterns. And let me clarify what is happening in this image. The first, we have a well-formed pin bar rejecting previous resistance level, which is now acting as a support level. The trend is clearly up and no immediate resistance above the pin bar. Now it has room to continue going. And the key to this pattern is that the pin bar must form in the direction of a trending market. Setting the take profit of a pin bar trade can be a little hard to explain, but I'm going to try and make it straightforward as possible. The first is to identify the support and resistance levels on the chart, then put in your take profit at the nearest major level. So how do we plan for a potential loss on a pin bar setup? By always making sure we have a stop loss order in place. Now the best place to put your stop loss on a pin bar trade is above or below the pin bar tail. And for a bullish pin bar setup, we would place the stop loss just below the pin bar tail. And the distance at which you place the stop loss depends on your comfort level as the currency pair being traded. A good rule of thumb is to put it 10 to 15 pips from the end of the pin bar tail. By lining up strong looking rejection candle with important areas on the chart, you can build a high probability, low risk and high reward trade setup. There are a lot of candlestick patterns out there on the chart all the time, but we have isolated the price pattern that yields the best result. We use these candlestick patterns to accurately anticipate future price movements, like the rejection candlestick. One of the largest benefits of price action trading is the fact that you don't need to worry about indicators to get your trade signals. You only need to concern yourself with one thing, and that is price itself. Now, a bearish market is just a mirror image. In the chart, the bearish moves are stronger than the bullish moves in the market, showing bearish dominance and pushing the chart down through lower lows and lower highs. The other type of market environments are ranging markets, where the swing highs and lows are all contained between two major boundaries. The market is consolidating in a sideways moving pattern until the boundaries are breached. Ranging markets are easy to identify. It's just two levels that the market is trapped between. Next, we need to talk about where to place your stop loss when trading the shooting star candlestick pattern. And when you do that, your stop loss should be placed at the nearest logical area, where if price reaches the area, you know you are wrong about the trade. In the case of the shooting star pattern, you know you are wrong if the price makes a new high. In the forex market, you pay the spread on the exit of a sell trade. So it's a good idea to have a little bit of space above the high of the shooting star to account for the spread. Otherwise, you may end up being stopped out. And the good rule of thumb is to place your stop loss 15 to 20 pips above the high of your signal. This gives you enough room to account for the spread plus a few extra pips in case the spread spikes slightly. Once price has moved in your favor a bit, you can move your stop loss to break even. Now this step is optional. It's possible for the shooting star candlestick to meet this criterion on its own if a bearish real body shooting star occurs after a smaller candlestick. Now, the first filter I want to talk about is the confirmation close. This is probably the most important filter that you can use on the shooting star, and it's the filter that changes the way you must take your entry with this pattern. Basically, as a sign that the uptrend is actually ending. After the shooting star signal, you want to see a bearish candlestick that closes below the real body of the previous candlestick. The sooner this happens after the shooting star appears, the better. The shooting star consists of a long upper wick that is at least twice the size of the real body. We discussed this when we were treating the topic candlesticks. It should have a relatively small lower wick or none at all. Its real body can be bearish or bullish, and it's usually small in comparison to previous candlesticks. And the shooting star candlestick patterns, like all the other candlestick entry signals, must be treated within the context of the market. A true shooting star candlestick signal can only come after an uptrend in price. The first setup on this chart is that during a downtrend, after the price broke a key support level, notice how after breaking trendline support, a bearish inside bar formed. The pair then retested former support as new resistance and carved out a well-defined bearish pin bar in the process. Now this shows two valid setups and one invalid setup. Notice how the first image shows a pin bar where the open and close are contained within the range of the inside bar. This represents a valid setup and is also the most common among the three. The second image shows a pin bar that closed above the inside bar's high. This is still a valid pattern because of the strong close by bulls. So strong in fact that it formed a bullish engulfing pattern as a result. Last but not least is the invalid pattern. Notice how the pin bar failed to close within the range of the inside bar. This is considered a weak close as it signals that the bulls are not in support of a move higher. It's generally best to walk away when you see this happen. I think of it as a false break of an inside bar. Think of it as a false break of an inside bar. More often than not, when you have a false break of any kind, the market continues in the opposite direction. For example, a false break of a key resistance level will often result in a steady decline shortly thereafter. This image illustrates how all the three pieces of the pattern work simultaneously. The first being the key level, followed by the inside bar and then the pin bar. The inside bar represents the stalemate between buyers and sellers. The bullish pin bar represents the false break of the inside bar and the key support level. And this aggressive push higher to hold support is what gives evidence to the reversal pattern. Notice the bearish pin bar that formed after retesting former descending triangle support as new resistance. Let's move in and take a closer look to see where we could have placed our stop loss for this setup. Notice how the bearish pin bar gave us a place to hide our stop. Without the tail of this pin bar, it would have been difficult to determine an appropriate level at which we can place our stop loss. Now, waiting for a confirmation price action gives you the perfect opportunity to do just that. When a bullish or bearish pin bar forms on a retest, you can use the tail of the pin bar as your invalidation level. In other words, if the market moves past the tail, the setup is no longer valid. And the term weak hands refers to any trader who is not comfortable holding a position through increased volatility for the opportunity to make larger gains. These are usually the traders who are too risk averse and therefore get stopped out prematurely before a larger move ever gets going. There are also those who trade the lower time frames and therefore aren't looking for the larger opportunity. These traders are happy to take profits early and often. Either way, both scenarios create swing highs and swing lows. As you can see, this chart shows a descending channel that intersected with a long-term support level. This support area eventually led to a break of channel resistance, which is highlighted. Retests in the forex market come in all shapes and sizes. They can come after a market breaks a key horizontal level of support or resistance, or a breakout from any form of triangle pattern. Regardless of how or where the retest occurs, the characteristics are the same. This image illustrates a few of the various ways retests can occur on a variety of price action patterns. In fact, I can't think of a single pattern that doesn't prompt a retest more often. But seeing one or watching one as it forms on your chart doesn't tell you the whole story. You have to know why it happens in order to fully understand the importance. This illustration shows a comparison of two markets that have recently broken a key resistance but exhibit different day-to-day movement. Notice how the first chart in the illustration shows a currency pair where the price action is quite choppy. When trading such a pair, it's often best to wait for a retest of a broken level before considering an entry. On the other hand, the chart in the lower portion of the image shows a currency pair that is much more clean. In this case, a retest of the level as new support is less likely. A controversial subject is the use of indicators in trading and how effective they really are. I believe indicators are one of the main catalysts of many forex traders' frustration. As price action traders, we don't need to rely on indicators to make our trading decisions. Let's talk about overtrading. The common misconception that more trade equals more money comes from a natural internal intuition of more work equals more results. And this is what we are taught in our day-to-day life. So naturally, you think this must apply to trading game also. Because of this more effort, more returns, mentally a lot of traders actually flock to low time frames and use high frequency trading strategies. These kind of systems have two major problems. The first is that they use small time frames which pick up the intraday noise of the market, making it hard to get a clean read on the chart and do accurate technical analysis. Channels are best described as two linear levels that run parallel to one another. They look like and sometimes are referred to as a railway tracks. You can get rising and falling channels. A rising channel is made from linear higher highs and higher lows. The two lines running in parallel create the support and resistance of the channel structure. Price bounces between these two lines and reversal signals can be picked up there. This is a nice bearish example acting as a resistance, which we did see a nice bearish reversal candlestick signal formed out of it. The bearish rejection candle signals it was still being respected as a resistance and that we should expect lower prices to follow. Now the setup produced a nice sell-off. It is just really simple logical thinking, just the way I like my trade ideas. One thing that throws a lot of traders off are false breakouts. So beware of false breakouts. This pattern is the engulfing pattern. Note that this is a double candle pattern. This means that the formation contains two candlesticks. The bullish engulfing appears at the end of a bearish trend as seen in this image, and it signals that the trend might get reversed to the upside. This chart shows you a shooting star candle, which is part of the hammer reversal family explained earlier. The shooting star candle comes after a bullish trend, and the long shadow is located at the upper end. And the shooting star pattern will signal the reversal of an existing bullish trend. A piece of advice that you might consider is that these price action formations are more meaningful on longer time frames. I typically don't take trading decisions based on the price chart of a chart less than 30 minutes. In this image, you can see a good example of how trading the hammer candlestick formation can be very profitable. This hammer signal was followed by a nice rally in price. Flags form when the market makes a pullback during trending conditions and are used as trend continuation patterns. The counter trend movement creates a small channel. When price breaks the channel in the direction of the trend, the continuation trade is triggered. In this example, the chart had formed a double top pattern. A bearish pin bar signal was communicating future bearish price action right on the neckline support. After price had broken the neckline, the market retested the neckline support as new resistance and produced a breakout trap and reverse trade. Candlestick patterns are awesome to use, but they should not be the first or only factor in your trade decision making process. Now, when analyzing the price action context, some things you need to consider are the current price structure, what is happening on the higher time frames, and you watch out for the forex price action to the left, and also the location of price to other important technical factors, and the presence of price action reacting with support, resistance, and trendline structures. This is how I recommend you approach a trade decision that involves a candlestick pattern. We've now come to the end of the topic forex trading strategies. We have successfully studied the most important aspects of forex trading. What remains now is just some tips to help you in your trading journey. I hope you've learned how powerful price action trading can be. Now you should know that not all trading setups you see will become winners. But here's the thing, if your losses are small but your profits are large, you will always be out in front. When you are watching the chart for trading setups, you need to see and trade the obvious. If there is an obvious pattern on the chart and you can see it clearly, then you should know that there are thousands of traders out there who are watching the exact same thing you are doing because it's so obvious. Things like trend lines or trend channels, bullish pin bar forming on major support level. You can see that there are many that will be seeing the same thing, and also all these traders will be waiting to see what happens at these levels. If a bullish hammer forms on a major support level, then guess what will happen next? The most likely outcome of that is that as soon as the high of the hammer candlestick is broken, price will shoot up. When you trade the obvious, then you trade with what everybody else is saying. Here are some things that I learned while trading. Levels get broken, and the more a level is tested multiple times, sooner or later it will get broken. From my observation, 2 or 3 times is the average. After that, expect a breakout of the level. The second, Do not listen to analysts. They can stuff up your decision-making process and cloud your judgment. So use your own independent judgment based on what you see on your chart. The third, find your best time frame to trade. Your personality, work circumstances, etc. may dictate what time frame you can use. For me, I can trade from the 4-hour, the 1-hour down to the 30 minutes chart. If the boss leaves you, do not chase the boss. In other words, don't chase trades. If you are late to get into a trade at an optimal entry point and realize that you might miss out, then do not enter the trade. Here are some psychology behavior in trading. The first, put your ego aside. Hoping and praying do not help. Living with the losses has to be learned. Never double your losses. Know your pain level. Diversify risk. Making money with trading is hard work. Recognize the importance of a trading plan. Nothing is more important than discipline. Now, this marks the end of our stage 4 lesson. I'm sure there are some topics that you could not grab. I urge you to go back and watch all that we have discussed. That way you will understand it better.